trading in financial instruments, whether it's forex, futures, or equities, takes place in markets. We already know that for markets to function it needs sellers and buyers. Supply and demand is all about spotting, where buyers and sellers are sitting on our trading charts. However, the retail traders do not have access to current order flow. We cannot spot them within their current position. All we can do is looking left of our charts and define previous supply and demand zones with the expectation that in those zones will still exist some serious buyers and sellers. Using lagging supply and demand information, we are making our trading decision based on historical data, not the current definitive data. We also know that what has happened in the past will not necessarily repeat at present time. We have to accept that, and to deal with probabilities. We use price action chart and candle patterns to improve probabilities in our favor. There is one important difference between classic supply and demand theory and supply and demand that applies to traders. While on classic approach suppliers generally stays as suppliers in the process of exchange, however in trading we cannot identify certain participants as sellers or buyers. All participants in trading can be buyers or sellers at any one time, even at the same time. Remember, trading means buying and selling. Buyers doesn't turn into sellers and vice versa. They already are both. When applying supply and demand in trading, keep this in mind. Foreign exchange market has many participants in various class and size. As we can see from the above graph, banks are firmly in control of forex. In spite of healthy growth of retailers' market share, banks will remain in control. Even if market share of retailers hits similar levels of banks, they will still be in control. Banks generally acts in sync, like one big cartel. Many funds and insurance companies are extensions of the banks. Retailers are extremely fractured and can't act in sync. According to the diagram above, retailers represent 18% of $4 trillion a day forex market in 2011. That represents hundreds of billions of dollars taken on daily basis. Unfortunately, it's mainly taken by the banks. Our task here clearly is to spot banks and follow them. Remember, we do not anticipate, but with guidance of the price we try to participate. That's all. Nothing more, nothing less. Supply and demand is considered the most profitable strategies you can use to trade the forex market. Recommended broker is Longhorn FX. Trade a wide variety of assets with leverage up to 1 to 500. How to sign up? It's as simple as entering a few sign-up details and creating a password. Be ready to receive a welcome email where you can later verify your account. To secure your account, it's recommended an extra step of verification, even by call or text message. As we all know, Forex is the largest market where traders buy and sell currencies. Prices move as a result of supply and demand forces. When supply is high and demand is low, price goes down, and when supply is low and demand is high, price goes upside direction. Once you understand the dynamics and relationships of these two forces, you will make better forecast with higher probability and success. These video tutorials will give you all the fundamentals that you need to master supply and demand in Forex. You will learn the core strategy on how to identify, draw, and trade market imbalances like real professional traders. You will also learn how to filter supply and demand zones. This filtering system will help you eliminate low probability zones and keep those with high odds of success. The supply and demand concept states that if the supply of a commodity is high and the demand is low, this produces excess which drives the price down. If the supply of a commodity is low and the demand is high, this creates insufficiency and then pushing the price higher. In the Forex market, when the supply for a currency pair is high and the demand is low, this will drive prices lower. If the supply for a currency pair is low and the demand is high, the excess demand will drive prices higher. For example, during times of uncertainty and fear, investors reduce their exposure in the equity markets and start buying safe haven currencies to protect their investments. The high demand for the Japanese yen will drive the price of the yen higher due to the high demand by the investors to buy the yen. This is exactly what happened on the coronavirus crisis. The investors start buying the yen, and as a result of that, the US dollar yen dropped tremendously. Another example is when the Federal Reserve, decides to increase the interest rates. This will make the US dollar attractive to investors because of the interest yield. This is also known as the carry trade, where traders buy currencies with high interest rates and sell those with low interest rates. Supply and demand is a general concept applied to anything that can be traded. Before we move to the core strategy, we need to define supply and demand zones and understand how prices move on the chart. Supply zones. A supply zone is located above the current price where there is strong selling interest. At supply level, sellers exceed buyers and price moves down as unfilled orders get absorbed. Demand zones. A demand zone is a price area below the current price where there is strong buying interest. At demand level, buyers exceed sellers, and price goes up as unfilled orders get absorbed.